Hey, welcome back, Rise Up, Live Free listeners. This is, I love doing this podcast every quarter with my good mate, Marck Lautour, where we talk about what our major takeaways was from the Collective Genius Mastermind. I believe my investors and buyers always get a nice gem from these podcasts and like whatever we take out of CG. I'm assuming it's the same with your mistake-free podcast listeners as well, but welcome to what's it called when you do a podcast that it goes on both channels?
JV, baby. It's a JV podcast, right?
JV podcast. So welcome, Rise Up, Live Free listeners. Welcome, mistake-free real estate listeners. So how's it going, Marck?
Good, mate. Yeah, appreciate. It's a little bit delayed, isn't it? Just we had kind of July 4th weekend right after the event, but boy, it was a great event, headlined by the keynote speaker, Bruce Norris, and got some key takeaways that would really analyze what's going on in the marketplace. I think your listeners will be very excited to hear that it's not all doom and gloom out there, Jimmy.
No, it's time to go on offense. We're going to get into this during the podcast, but like I walked out of CG like ready to rock. What you want to talk about? Your mood going in, the room's mood going in, or just where do you want to start?
Yeah, I think the general pulse, my takeaway is the general pulse on the market. Again, the Collective Genius Mastermind that Jimmy and I are both a part of is the top 1% of real estate investors from all over the country. So you've got the best networkers, fix and flippers, wholesalers, real estate, multi-family syndicators, apartment complex guys, storage guys. So literally like cream of the crop from all around the country. And the pulse in the room was bullish on the economy. I feel like for the last 2 years, we've been beating the drum of kind of a profit first model, sticking some cash in the bank, be prepared for the downturn, work on culture, have good people around you. And so I think in general, the mood inside CG was, okay, that's what we've been waiting for, but the market is turning, right? Clearly, we are seeing the pendulum swing back the other way. But I think overall, there was a feeling of, okay, we're prepared, but now the hard work begins. Even when you're prepared, that doesn't mean it's going to be easy by any stretch of the imagination. But with chaos comes opportunity. And I think the chaos, as we learned, is not going to be dire, but there's going to be a little disruption in the marketplace, and I think we're there to take advantage.
And from a turnkey provider and a turnkey buyer perspective, like Eric Brewer, another big turnkey guy in the group, everybody who's in the turnkey game will say, hey, the last 2 years have not been easy. Like the whole rest of the market might be crushing, but for turnkey wise, just finding inventory has not been easy. And we'll get into it.
Yeah, I think the ones that are going to feel the pinch the most are just wholesalers, guys that are just retrading and providing no value. But those that are actually doing fix and flip, they're actually doing new construction or actually doing turnkey through a buying distressed, remodeling and selling to an end user investor, the outlook is rosy in my opinion.
Completely agreed. And like the interest rate hikes, like it's made me angry as a wholesaler. I was just not angry, just angry because now we have to work harder. And it was really, really simple and really easy, but still, like you said, chaos brings opportunity. So even as a wholesaler, I still see a lot of opportunity, but as a turnkey guy, I'm just like, my greatest anxiety the last 18 months in the turnkey game was having enough inventory. Have you, any of that anxiety hit you?
Yeah, for sure. I mean, obviously that's the biggest challenge, and most people were just putting something on the MLS and everyone wanted to buy. So there's an extreme lack of inventory. I think that's going to change drastically, but can we unpack what you just said? I think there's two big things. Clearly we want to get to Bruce Norris. I think we can leave that for later in the episode, but you mentioned the interest rate. Everyone wants to know, Jimmy, about interest rates. And you said that as a wholesaler, as a reminder, we don't wholesale, but you do. When you said interest rates, were affecting your wholesale business, let's talk about interest rates and unpack that. What do you mean by that? And how have they impacted your business?
So as a wholesaler, we were getting things under contract that we didn't rehab, didn't touch, didn't do anything to. And we were just putting it on the MLS, and a retail buyer was buying it overpriced. And like we knew
those days are gone.
Yeah, we knew that day that was not a sustainable business model, but it's like going to a party. Like, you understand partying your entire life is not going to last, right? But you enjoy it while you're there, and then you just muscle through the hangover. And so it's just been the whole interest rate thing, not really a big deal, but like, I was angry. I had to muscle through a little bit of a hangover, and then silly, stupid, easy things are gone. And even when we were getting these deals done, we were laughing. Like, I can't believe this is happening.
So clearly that doesn't really impact our audience. Our audience are buying turnkey properties. They want to invest in real estate. They want to follow our lead and try and build wealth through real estate. How does interest rates impact their growth?
I think it provides opportunity because now they have actual inventory, because there's actually opportunity to buy now.
So for an investor, let's be clear, yield or cap rate does not change when an interest rate goes up, but their cash on cash return does. So I've had some of my investor clients say, hey, interest rates are going up. You know, my 4% rate that I was getting from the banks now at 5.5%. You know, what have you been counseling your investors when they come and talk about interest rates going up?
Same thing. Like, hey, congratulations if you were able to buy the last 18 months, that you were able to get very low interest rates. But we all understood that was not sustainable. And if your plan is to build a portfolio in real estate and only invest in 0% interest rate environments, you'll never be an investor. And that the interest rate is going to go up and going to go down. So it's our stance at Cashflow Tactics is that as long as the interest rate is fixed, it doesn't matter what it is. So your cash flow might take a dip year 1, but it is not going to be taking a dip in year 10, because you have that fixed cost of, your interest. The fact that cost won't change for 30 years unless it goes lower when you refinance. Mm-hmm. And the fact that rents are going to continue to rise with inflation, that cash flow delta is just going to grow.
Yeah, that's what my reassurance has been, and why interest rates going up are actually less of a concern, because even though, yes, your cash on cash return may go down significant or, a small amount this year, what is more significant is the fact that interest rates are going to create more renters for the marketplace. I've done some math here, because it's, we have a saying here, IJM, it's just math, and it's a math exercise. Actually, Bruce Norris said that as well. Recession is just a math exercise. But a $300,000 mortgage, Jimmy, at 3% interest was only $1,265 a month. That's why there was such a demand for housing on the buy side, was because you can go buy a $300,000 home, and the principal and interest, again, I'm avoiding taxes and insurance in this example, was just $1,265.
Yep.
Now at 6% interest rate, they've gone up by $600, up to just over $1,800 a month at $300 at 6%. So suddenly $1,800 a month, if they could rent a house for $1,400 at $1,265, it was cheaper to own. Now it's going to be way cheaper to rent. And that is an opportunity with fewer people buying. There's going to be more renters in the market, which will obviously, not only is interest rates causing you the appreciation, but they're also in your sales price, they're also increasing the appreciation in the rental rate.
And I left the meeting being like, if you are in the rental industry, it is game on. I was excited about the rental industry as I was excited about the retail industry 18 months ago. Yeah. We had that meeting in Phoenix where you're like, Jimmy, you got to get your retail game going. And, we ran out and did that. I felt that same feeling leaving this meeting.
Yeah, we actually doubled down and hired a second full-time leasing agent for that reason. We know that we're going to be able to increase inventory, and that the most critical factor is to be dialed in on your rents to make sure that we're maximizing return, not only when we're analyzing the turns that we're doing for existing owners, but also when we're bringing new inventory into the fold. We need to be dialed in on exactly what that market rent is going to bring.
And what do you think about this thought? But like, the last 2 years for our audience has not been that great. Sure, if you've been able to get in the game and get a turnkey with the inventory shortage, because the biggest complaint I've heard is, Jimmy, I can't get enough inventory for 2 years consistently. That I I don't know that the last 2 years have been great for the turnkey industry.
No, the biggest complaint of ours was always, okay, I'm in. I love the concept. I want 10 this month. Sorry, you can have one, then get back in line, be patient. Yeah, it was tough. You're catering to a huge demand for rental real estate. And what's funny is those foolish investors, there are some foolish investors out there that have got one or two houses that are now saying, oh, real estate, I've got, it's been 2 years and I've got 2 assets and I just had someone move out and they're looking at this like a 50% vacancy rate. And I'm thinking, my goodness, you need to scale up. I've always said real estate is best done at scale. If you're not going to scale and get to over 10 or 20 homes, it's really not worth doing.
Yeah, I think you either do this to get 5 or you don't do it at all.
Yep.
5 at a minimum. So let's get into it. Tell us about, you did a great job because you do coordinate the keynotes every time. I love this guy. Tell us who Bruce Norris is.
Yeah, so I falsely introduced him the first time I talked to him as an economist. Bruce is actually just a self-made real estate protagonist that really has done a good job of forecasting markets. He's a data nerd, self-confessed data nerd, that really, and California-based investor. He was doing new construction. He and I had a similar upbringing in the real estate where we both focus on foreclosures. So he and I share an affinity for the courthouse steps. We're buying just hundreds and thousands of homes on the courthouse steps. And so from there, he made a lot of money, built up a big portfolio of rental real estate, and then started doing hard money lending. And that's what kind of turned him through 2008 and 9. He started doing a ton of hard money lending, and then started doing new build construction. He actually sold off or stopped buying speculatively in California in around 2006 because he saw this massive amount of crazy lending practices around
fraud.
that time. Yeah, exactly. He said he was interviewing a lady one time that was, I can't remember who, but it was something like a chief mortgage lending officer for Deutsche Bank or something crazy, and said, tell me about these, those no income, these ninja loans, no income, non-qualifying mortgage loans. What is your, strategy on those, and what is your plan? And she just said, oh, we don't, or he said, how do you verify income? He said, we literally don't verify income at all. It's just whatever they tell us they're making. And he said, as soon as she said that out loud on stage, he's like, okay, I've got no further questions. And literally went to just selling all his inventory off and just waiting for this massive downturn that he saw coming. So anyway, obviously a smart guy, was able to pivot, put his chips on the sideline, and then re-engage and double down when he got into 2010 through 14 and started doing new construction. So anyway, he's long been, the Norris Group has been kind of forecasting and being a real estate bellwether for investors. And we had him come in and he really delivered some sound advice, not only on how to protect and preserve what you've got, but also what he saw as what's upcoming in the next 12 to 24.
And then if you guys want to know more about Bruce Norris, if you're a Rise Up, Live Free listener, go to Marck's podcast. I thought your interview with, you did about an hour with him. I thought that interview was phenomenal.
Appreciate that. Yeah, that'll give some insight. He didn't go as deep as obviously what he did in CG. That was kind of a teaser, but yeah, he certainly laid down exactly what he thought was going to happen in the upcoming 2 years. So yeah, if you want to go deep on Bruce Norris, go to mistakefreerealestate.com on YouTube, and you can check out that podcast there. We'll put a link to it in the show notes.
And there was quite a few takeaways, but if you take econ, I'll just butt in and tell you my takeaways, and then we'll get to yours, Marck.
Please.
But if you econ 101, you would assume that if the interest rate goes up, that the price of housing would go down, right?
Yep.
Basic supply demand economics 101. Unfortunately, the reason there's economics 201 and 301 and 401 is because at a certain level, economics 101 falls apart and history doesn't support it. So for example, when interest rates were at their highest in the late 70s and 80s, this was shocking to me. Like, this was the economic fun fact I learned. It's that interest rates doubled in the late 70s and housing prices tripled. That was absolutely fascinating to me. Because I was counting on, oh, interest rates are going up. Okay, prices are going to go down. And I don't believe that's necessarily true.
He proved categorically that that is not true at all.
And because, when you're in a big economy, when interest rates are going up, it's an indication that inflation is out of control. And when inflation is out of control, cash rushes to hard assets. So economics 201, it makes perfect sense why housing prices would not go down.
Yeah, so a couple of things along that line. There's only 3 times in history that Bruce has said that used homes have actually been more expensive than new homes. It is very rare that there is not a strong correlation between new homes and used homes. And so when new home prices are going up due to the supply chain and the increasing cost of lumber with gas prices going up, everything gets more expensive because everything has to get to its destination on a truck somehow. The greatest hedge against inflation, he said, was real estate, because your house is a basket of commodities. Think about it. In every house, you've got sheet metal, AC, lighting, doors, roofs, windows, siding. I mean, everything goes up. You've got a box of commodities sitting there. So every single time inflation pushes it up, those that are holding are just gaining in value. A used home is extreme value.
And Mark, I actually pulled up his slide. I got it in preparation for this podcast. I got a slide, but so here's how he broke it down. Rental house is simply a basket of commodities that goes up during inflation. When Lennar's lumber goes up, so does your house. And that real estate is better than gold because you can use leverage. Better than gold because it cash flows. Better than gold because it increases in cash flow and eventually pays itself off. That kind of speaks to what I already talked about.
He spoke about the 4 pillars.
Yeah, it was amazing. And then with leverage in real estate, you can own commodities that cash flow and keep pace with inflation. And then we've been told all our lives on what goes up in real estate is the land. That's not true. It's the basket of commodities on top of the land that actually goes up. And because here's the deal, if the interest rate is going to scare you and you are not going to use the pillar of leverage, you lose so much. This is why interest rates don't matter. It's the fact that you can get 30-year fixed financing and buy baskets of commodity that matter.
No question. I mean, real estate is not complex, Jimmy. You and I can do a podcast every quarter. It always comes down to the 4 pillars. Real estate has cash flow, appreciation, depreciation, tax benefits, and then you can leverage it to get more than you really should, because the banks are so literally, leverage is basically the idea that a bank is saying, I'm so secure. In fact, they have a saying, as safe as houses.
Right.
The banks are so sure that real estate won't go down in value, they're willing to put up 80% of the money for you to go buy an asset.
Well, it won't go down in value for an extended period of time.
Yeah.
And this was one of the main thoughts that got me into real estate in the beginning. I read a book called 401 Chaos by Andy Tanner. And it was, hey, he challenges people, take your 401k statement and go to a bank and see if you can leverage against it. And what will the answer be? It's always no. And that's because the market is inherently volatile and inherently unstable. But you take 1,000 square foot house with 3 beds and 2 bathrooms, and you can get millions of dollars of capital lent to you. So once again, that's why, casual taggers are like, as long as the interest rate's fixed, who cares?
Cash flow tactics almost should be wealth building tactics, right? I mean, cash flow is kind of a secondary means to an end. I'm not minimizing your name by any stretch.
No, I kind of want to change the name too.
I mean, if you think about it, like, cash flow is not why you buy real estate. Cash flow is a side benefit.
It's a permission slip.
Yep.
Because I would, like, none of your rentals, you don't feed the rental every month with cash, right?
Oh, are you kidding me? No, I haven't ever. Yeah.
So cash flow is simply a permission slip, because you don't want to be buying assets that you have to feed with your active income every month.
Bingo.
Yeah. So it's very binary. It's either cash flow positive or isn't. But to not do a deal because it only cash flows 4% year one, and give up the other 3 pillars, it's just not a great investing strategy.
Yeah, for those of you that were there at the Cash Flow Tactics event in St. Louis that I spoke at, what was that, May?
Yeah.
I kind of opened up my playbook, which I've never done before, and showed my portfolio. And, everyone looked at the cash flow that I'd had over that whatever it was, that 18-year time period that I'd owned rental property. And it was a big number, right? Yep. And everyone was saying, oh my gosh, I'm like, no. That, like, everyone clapped in the room, and I'm like, no, that's not the number. Then I showed them the equity that I'd gained, and everyone was like, oh my gosh. I'm like, it's building wealth. It's not about the cash flow. It's about the wealth building over time. That's the generational aspect of the game that we play, Jimmy, is you can change the lives of your children by just buying. It's not even rocket science. It's just you buy and you hold.
And Mark, do you know what the aggregate interest rate is that I've held on my portfolio over the last 6 years? 9%.
What?
Yeah, because I don't like dealing with banks. And so Brad showed me numbers at how on interest only loans, I can come out ahead as far as getting a lower interest rate. And it's how would you describe the strategy? It's a different strategy. It's not commonly held, but I held half my portfolio in private money.
Well, that's a scaling up strategy. So it's an aggressive scaling up strategy to get volume and equity, which was smart because clearly those homes have doubled in value in the last 10 years. So,
right.
Yep.
So it's just, it can be done, but like, I think you and I both sleep well at night with the principal pay down and the equity that's developed over time. And then the cash flow has been kind of cool.
Very. Yeah, no, I mean, my strategy with real estate is it's a wealth building tool long-term. And as long as it does not impact my active income, meaning I don't have to top it up every month, then the rest is gravy. I think the investors that I sometimes have to counsel, off a ledge are ones that have one or two assets that have not maintained our scaling strategy. And I've only had one per year rather than one per quarter. And, they have one house that goes vacant. They're at 50% occupancy. And then, one bad experience, which, we're eyes wide open. We tell people right up front the dangers of real estate, vacancy and maintenance. And sometimes a tenant can beat up a house. If you have 10 houses, that's 1/10 of your portfolio. If you have two, it's 50% of the time. So yeah, this one tenant came in and gave the house just left it in terrible shape, and was one of those kind of professional tenants that tried to stay in as long as possible. We had to go through the eviction. So it was like 90 days of no income. Plus then he's got a big, uptick on his turn bill. And he was just panicking. And I'm like, dude, if you're in it, so then I went back, Jimmy, and actually looked, and he had $80,000 of equity appreciation in the house. And he said, Mark, but that's not why I'm doing it. I'm doing it for the cash flow. And I'm like, okay, we'll sell the house. And, you've got that cash flow for that whole time. I mean, I just couldn't understand his rationale when he says to me, no, I'm not, I'm doing it for the cash flow. I don't care about the 80 grand. I care about my $200 a month. I mean, it just made no sense to me. And
then the greatest part is like, this $200 a month for these high net worth individuals is like a big deal. What they make in 1 hour, they stress about over one rental.
Yeah.
It's like, but it just takes time. I was the same way when
hey, I'm not minimizing. Hey, look, cash flow's awesome when you're in retirement and using that as a method to offset having to go to work and create active income. But it's the maturity to start at a young enough age where you can get those paid off, that not only do you have this huge pot of equity, but you do have the ability with scale, to get to 20 or 30 doors that are kicking off. The biggest misnomer is that fully leveraged, 80% leveraged assets will actually cash flow enough to just put you in retirement. Doesn't happen. But once those are paid off, it's an absolutely a good path to retirement. If you can get 20 doors that are cash flowing $1,000 a month, that's 20 grand a month, and most people can live on 240 grand a year.
Yeah. And then you use leverage in the early years to blow up that balloon.
Bingo. And those who don't use leverage will suffer the consequences down the road because they didn't scale.
And then that's why, like I said, since the interest rate bump, wholesaling, still fun, still great to do, still have to do it so I can find turnkeys. But the turnkey demand has actually been rising because I think we're doing a better job teaching about what we're talking about today. I think, the way we used to sell these, I think it was lazy and I think it was sloppy because we could make a magical 1-year return. We did.
So for those listeners that may be hearing you for the first time, can you talk about how you used to sell turnkeys and what you're telling people now?
It was like, hey, 10% cash on cash year one, and then buy. And sometimes people would take assets that cash flowed, but didn't have a chance for appreciation. And now we're selling a more well-rounded asset that is going to lead to long-term wealth creation because they see the value of the 4 pillars. And just if you're new here for the first episode, 4 pillars are appreciation, cash flow, leverage, and tax advantages. And it's like, the reason I hate the stock market is because it's like there's only one way to win. I don't like playing games where there's only one way to win. It's like playing football before the forward pass. 11 guys would just line up next to each other and just bang into each other. I like to win games in multiple ways. And so with real estate, there's always 4 ways to win.
Love it, Jimmy. What else you got, mate?
What else you got? So the other thing in the back of everybody's mind is like, are we hanging on to an economic recession? Are heading into another 2008 scenario? And then
let me address that because Bruce actually talked to that quite significantly. He talked about the ratio between foreclosures and active homes for sale on the market and how that's a statistic that you should really look at.
And that was genius.
Remember that in a recession, sales will slow, inventory goes up, building will slow, and foreclosures will go up. So it's kind of an up, down, up, down. Sales slow down, inventory goes up. Building slows down, foreclosures go up. Now, 2 things to notice was that the 2008 housing crisis was a lending crisis. So
it was a fraud crisis. Let's be authentic and real, Mark. It was a fraud crisis.
Yeah, clearly people were defrauding the mortgage banks, and the mortgage banks didn't care.
Yes.
They were just putting, hey, I make $1 million a year. Okay, great. You can have as many houses as you want. Go to town. So yeah, it was a fraud crisis that caused these banks, shame on them, to lose a bunch of money. And then obviously the bailout that happened. But it's important to note that the reason that really stifled the normal growth that comes from appreciation was that foreclosures was such a strong part of our sales inventory, meaning, and I'll use California stats here just because that's what Bruce quoted, and I don't have mine handy, but they would be very, very similar. In 1980, there were like 400,000 sales in that market, and 25% of them were foreclosures. In 1990, it was about 40%. In 2009, it was 75% of all sales were foreclosure properties. Now, the way he analyzes that is he says, look, if it's 1 in 4, the appraiser says, hey, that's not really significant. If it's 2 out of 4, the appraiser says, okay, I'll give some weight to that, but it's not really a stat. But he said, at 75%, your foreclosure is the comp. So when banks are willing to just dump real estate, your foreclosure is the comp, and it stifles appreciation and stifles the actual sale of house flippers. We don't see that. Bruce does not see that happening here. It is not a lending crisis. It is not a fraud crisis. Now, will foreclosures increase? Absolutely. There will be,
Can I say something to that effect, Mark?
Sure.
So you're going to see headlines on CNBC, foreclosures in this market up 300%. And that's going to be because there's 3 foreclosures because the last 2 years there's been 1.
Yeah.
And so don't pay attention to the rate of growth in foreclosures because quite frankly, because of the moratorium from COVID, foreclosures have to go up. And quite frankly, with the inventory crisis, it'll be a healthy thing.
So that's exactly right. He said that the statistic to watch is the number of foreclosures in relation to other sales in the marketplace. That is the stat to watch, not how much foreclosures have increased year over year. But again, remember, there's a big difference between noise and news. The noise out there in the marketplace, which comes across on CNN, and they'll say foreclosures are up 3,000% because it went from 1 to 17 foreclosures in a particular marketplace. Well, that's not news because there were still 1,700 other sales and it was 1% of foreclosures. You've got to understand the percentage of foreclosures as it relates to all other sales in a marketplace. That's how you determine and create your own narrative around it.
And that was it. I mean, that was a pure gem from Bruce on that.
Yeah, so it's something to certainly impact. The other impact, obviously, Jimmy, is that affordability, we've got to be real. Affordability goes down, right? So how does that impact? Fewer people are going to buy. Only the quality homes, I think, will be the ones that fly off the shelf. Everything else will come back to sit on market for 30 or 60 days. Oh my gosh, a house might have to sit on the market for 30 or 60 days retail. Like, guys, this is, I don't know if you were around, for the last 20 years, but it's only been the last 2 years that something got highest and best multiple offers in the last, on the first days on market. That is very, very rare. The normal life cycle of an MLS property is around 60 days.
And yeah, it was unsustainable. And like, it wasn't good for the country or the economy, the way you could just throw something up on the market and have multiple over ask offers.
Yeah, and that fluff is gone. How we have adapted here at SBD, when we're acquiring property, is we have analyzed the market and basically said, look, the real estate market is not tanking. It's not going down. Average rates are still going up. We're still getting the average. I was looking at the stats yesterday for last month in the Kansas City marketplace, and we're still getting over list on average, over the original list price, 101 or 102% of list on our properties. However, the fluff in the market is gone. The fervor in the marketplace has subsided, where you're not going to get a house that was listed at 300 that should sell at 300. That's a $300,000 house. It's not going to sell for 330 because you had multiple offers on it. Those days are gone.
Yeah. And then that was the main takeaway of the room in CG. Like, hey, we had our fun. This was cool. Now we got to go back to a regular market and go back to work. And then, I know I was doing some speculative shenanigans trying to get, I got burned on one, but like, I was saying, we'll do this because the market's so hot. Like we got spanked, and then we're just not doing that anymore.
Jimmy, one last thing that I think people would be interested in, because you and I have talked before about institutional buyers. I think in your room, there was a good presentation about the funds. Is this going to scare off the funds, or rising interest rates? Are they going to stop buying? What's the pulse on institutional buyers in your market?
Institutional buyers are looking at this as an opportunity. And I think the last 6 podcasts we've done together, it's like, if you are a turnkey investor, you need to look at the asset like an institutional buyer. And that these guys, and then there were 2 hedge funds buyers in the room, and they're saying they're looking at this as a huge opportunity, because people are going to have to cater to turnkey buyers now. They're going to have to cater to hedge funds, and that essentially there's not the silly retail buyer coming in there and really disrupting the market. And so just because of all the things we talked about, that this is not a fraud crisis like 2008, homeowners, not like 2008, homeowners right now have a tremendous amount of equity. So no one is really going to help alleviate this inventory crisis. So hedge funds are saying it's still go time, probably better than it was 6 months ago.
Is Wall Street smart money or dumb money? I would argue that most of the time they know what they're doing, right? I mean, institutional buyers have practices, procedures, buying criteria. For a while, we thought they were dumb money because they would pay so much for a house. What we're realizing now is that they are not dumb money. They're very, very, very smart money, because what they're doing, Jimmy, is they're realizing that this is an opportunity. And they're also realizing that real estate is the long game. They're in this game for 50 years. They have a 50-year horizon, and some of our investors have a 12-month horizon. We need to understand that a 50-year horizon means you buy and you hold. You let a dialed-in property management company manage the 2 big killers of cash flow, vacancy and maintenance, and the rest will take care of itself.
And then that's the other thing. If your time horizon is 12 months, you're not an investor, you're a speculator. I'd say if your time horizon is 60 months, you're still a speculator. So if you truly want to be an investor, just like what you said, Mark, it's a long-term buy and hold.
That's all I got, man.
That's all I got. I love these recap episodes.
I hope everyone gets value in it. I feel like, CG is forward thinking. You know, as part of the leadership team, one of our jobs is to make sure that we get in front of what's coming down the pipeline. And we knew that there would be, with this market turning, that everyone would be a little bit scared. I shouldn't say that. We knew that everyone would be questioning what was coming down the pipeline, and we wanted them to be as prepared as possible. I think our whole goal was to have people leave empowered and prepared. And I think that they left very empowered and not scared at all with what's coming down the marketplace. They're ready for some hard work, roll up the sleeves. But yeah, it's go time.
And then I need the mentors at CG to say, hey, here's what's coming down the pipe. Here's what we see. Because you guys will always keep the group 180 to 90 days ahead of what's going on.
You got it.
Thank you for that. All right, Mark, you got anything for your audience? You want them to check you out on YouTube?
Yeah, no, always good. If you guys, we're actually putting out some good content. You can look for us at Instagram at Marck Lautour, as well as YouTube Shorts. We're putting out some really good YouTube content, not only from podcasts, but also from some reels and YouTube Shorts. So please go to mistakefreerealestate.com, hit the subscribe button so you don't miss out on any of that video content. Very much appreciated.
And then if you're interested in cash flow tactics, check us out. We're actually going on TikTok next week. Check us out on TikTok, Instagram, Facebook. And if you're looking for that masterminding, how to get somebody help you be 180 to 90 days ahead of the game, check out our mastermind programs. So thank you for your time, Mark.
Thanks, Jimmy. Always a pleasure, mate.
All right. See you, dude.
You're listening to Mistake-Free Real Estate Radio, the authority in passive real estate investing. No late night calls, no clogged drains, no tenant nightmares. Take the passive investor's approach to real estate investing and trust a turnkey professional. Learn more at mistakefreerealestate.com. Until next time, remember, you don't get rich from what you earn, you get rich from what you own.